Hey everyone, welcome back to another dividend investing video. In today's video, I'm excited to share the stocks and ETFs I've been adding to my portfolios this January. Now this includes my Roth IRA and my public taxable dividend growth income portfolio, which I share here on the channel. Now I'll give you a transparent look at what I've been buying this month and the reasoning behind those moves. So whether you're looking for fresh ideas or just curious about my strategy, you're in the right place. Now let's dive in and talk about building that growing stream of passive income. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Okay, now we're going to start off with the purchases I made this month in my dividend growth income portfolio. For those of you new here, the portfolio is something I started a little over 2 years ago when I first launched this YouTube channel. My goal was to document the journey of building a dividend portfolio completely from scratch. This account has grown steadily since then. It's something I actually did after I settled my divorce. This is a taxable account that I hold with FIdelity. It's separate from my retirement accounts like my Roth IRA, my 401k through work. One of the reasons I choose FIdelity for this portfolio is the ability to buy fractional shares. It makes it really easy to invest specific dollar amounts instead of needing to purchase entire shares, which is nice for when you're starting out in a smaller account. Another feature I take full advantage of is DRIP, dividend reinvestment. Every stock in this portfolio is set to automatically reinvest dividends right back into the same stock. It's a simple way to keep the compounding machine running without needing to do anything extra. Now on January 6th, I made my first purchase in the portfolio for 2025. I bought $100 worth of Mondelez International, ticker MDLZ, which added 1.697 shares to my current position. Mondelez, like its competitor Hershey, has been significantly impacted by rising cocoa costs, and this has weighed on the stock. It's one of the reasons it's among the few positions in this portfolio currently in the red. Now, despite that, I still believe in the company's fundamentals, which makes now a great time to continue building my position, in my opinion. Mondelez boasts an impressive 10-year track record of dividend growth with an 11% average annual dividend growth rate over those last 5 years. Now, right now, I think Mondelez shares are looking ridiculously undervalued, and I'll be diving deeper into this company in an upcoming video, so make sure you have those notification bells on so you can catch that when I put it out. Now, on January 8th, I made additional purchases to two of my dividend-focused ETFs. That's SCHD and VYM. I bought 1.838 shares of SCHD for $50 and 0.392 shares of VYM for $50. These are two core holdings in this portfolio, and since the beginning, I've consistently added them in equal amounts when I buy them. Think of it as somewhat of an experiment I'm using to compare the performance of these two, and at the moment, these are the two largest positions in the dividend growth income portfolio. SCHD has delivered more in dividend income, while VYM has provided a higher total return. So both have their strengths. We're probably due for a video where I'm going to focus deeper on how these two have compared over the last couple of years of my purchases. But for now, let's briefly pick out the top 10 holdings in each ETF and see what makes each one unique here. Those top 10 holdings in SCHD are Pfizer Inc. at 4.3%, Bristol-Myers Squibb at 4.19%, Coca-Cola Company at 4.14%, Amgen Inc. at 4.1%, AbbVie Inc. at 4.05%, BlackRock Inc. at 4.02%, Chevron at 4.01%, Home Depot also at 4.01%, Cisco Systems Inc. also at 4%, Lockheed Martin Corporation at 3.93%, and these top 10 make up 40.74% of the total SCHD fund. So that's really heavy on pharmaceuticals right now. Now this is going to rebalance in a couple months in March. We'll see what comes of that then. Then let's look at VYM's top 10 holdings. This is quite a different fund than SCHD. You have a top 10 of Broadcom Inc. making up 6% of the fund. Then JP Morgan Chase making up 3.84% of the fund. ExxonMobil at 2.75%, Procter & Gamble, ticker PG, at 2.25%, Walmart Inc. at 2.23%, Home Depot Inc. 2.2%, Johnson & Johnson 1.99%, AbbVie Inc. 1.79%, Bank of America Corporation 1.67%, and Merck Company and Inc. 1.44%. These top 10 make up a total of 26.15% of VYM. So VYM has a lot more holdings than SCHD, which is much more concentrated on just that 100 stocks. more heavily concentrated on that top 10 where it was 40%. So these are two different ETF strategies that I like and I'm using right now. And moving on to my next purchase, on January 10th, I invested another $100 into the portfolio, splitting it between Next Era Energy, ticker NEE, and Procter & Gamble, ticker PG. So I bought 0.738 shares of Next Era for $50 and 0.314 shares of Procter & Gamble for $50. Next Era Energy is the lone utility company in the portfolio at this time, and I think it's been attractively priced over the last month. They have one of the strongest dividend growth track records in the sector and are a leader in renewable energy, which gives me confidence in its long-term potential. Procter & Gamble, this is a classic blue chip dividend stock, a core defensive position in the portfolio. It's steady, reliable dividend payer with a solid track record. The business is easy to understand, provides essential products that we all use in our day-to-day lives, making it a cornerstone for stability and growth. Now, on Monday, January 27th, the markets were shaken by news from DeepSeek, a Chinese artificial intelligence company with capabilities rumored to rival that of ChatGPT. This sent shockwaves through the tech sector, with major players like Nvidia, ticker NVDA, and Broadcom, ticker AVGO, taking significant hits. Nvidia saw its stock drop a whopping 17% that day. So I saw it as an opportunity to add to my Broadcom position that's in the portfolio for the first time in quite a while, purchasing 0.0468 shares for $100. I also made the rest of my January purchases there on the 27th, purchasing 0.471 shares of Waste Management, ticker WM, for another $100, continue to build on this steady, reliable position. And lastly, I added another $100 into Next Era Energy, increasing that holding by 1.385 shares. The Waste Management strikes me as a no-brainer for it's a simple buy and hold dividend growth powerhouse. As North America's largest waste services provider, there's so much to appreciate about their business. They've delivered 20 years of consistent dividend growth with an impressive annual growth rate of 10%, with a low payout ratio, record revenues, growing free cash flow, steady share buybacks, high returns on invested capital. They check nearly every box, aside from valuation perhaps. Waste Management typically is a stock trading at a premium, but right now I'd say it's closer to its fair value. So for me, it's exactly the kind of business I want as an anchor in my portfolio. It's reliable, resilient, rewarding over the long term, and it's the kind of business I'm happy to pay a fair value for. And I hope to continue adding to this one, making it one of the larger holdings in the fund. So altogether, that's $600 of new purchases added to the Dividend Growth Income Portfolio in January. And that doesn't include my dividends reinvest. As I mentioned, I have all the holdings in the portfolio set to drip at the moment, and I'll cover the dividends received in this account in the next video. The $600 is a little bit lower than my typical monthly contribution to this portfolio. Here's a look at my spreadsheet where I track every dollar I've added into this account. In 2023, I contributed about $14,000, and in 2024, I did about $15,000. So this year, I'm scaling that back a little bit because I need to focus on a few other financial priorities, such as 401k contributions. I also opened up a healthcare savings account for the first time. My employer made that available, so I'm going to fully take advantage of that. And I'm also building up a cash position in 2025. So I'm putting a little less emphasis on my dividend growth portfolio for a little bit. And for these reasons, I've set my contribution goal for the dividend growth income portfolio to $10,000 for this year, with plans to go heavier in the second half of the year, and then planning on a $20,000 contribution goal for 2026. So that's my dividend growth income portfolio purchases for January 2025. Let's shift gears over to my Roth IRA purchases for January. Okay, so my Roth IRA, this is an account I prioritize for tax-advantaged growth. I'm going to max it out no matter what I have to do. For 2025, I've created a funding plan to max out the $7,000 annual contribution limit. So my strategy is to contribute $600 per month for the first 11 months. And then I'm going to finish with $400 in December, totaling $7,000. If you're over 50, you can do $8,000 total. Starting in January, I've already added my first $600 to get the ball rolling. Maxing out the Roth IRA each year is one of the most powerful steps we can take for our long-term wealth building because contributions grow tax-free, and qualified withdrawals in retirement are completely tax exempt. For someone focused on dividend growth investing, this is a perfect account to hold assets that will generate increasing income over time. I definitely prioritize this over that dividend growth income portfolio. Maximizing the Roth out is a must. This portfolio is held with Charles Schwab, so unlike Fidelity, it doesn't have the fractional shares, at least to the extent that Fidelity has them. So here I'm purchasing entire shares of stock and ETFs. And another difference in strategy here is I'm not dripping or automatically reinvesting dividends here. I'm going to use the dividend income I generate in the Roth to help boost my current purchases, allowing me to be more selective with how my dividends are reinvested. And I think there's pros and cons to both approaches. So I'm doing both, and I'm doing one in one account, and I'm doing the other here. Drip is being more hands-off, But as you start to get more dividend income, I think it's nice to be able to direct them where you want them to go. And I really think it's a matter of time before this is what I start doing in the other port. So what I've been doing for the last 2 years in this account is I've been consistently buying SCHD in the account every single week. Initially, I was doing 1 share per week, and after the split last year, I bumped that up to 3 shares per week. So I did a 3-to-1 split. As for now, I hold 312 shares of SCHD in the Roth IRA exactly. Last year, I also purchased 1 share of SPLG every week. This is an S&P 500 index fund, so now I hold 52 shares of SPLG in the account. These 2 funds made up the vast majority of Roth IRA purchases for the last year. So in 2025, I'm taking a slightly different approach. I'm splitting my contributions across 3 different strategies. So about 33% of the purchases are going to be focused on real estate investment trusts, REITs, the perfect type of investment for this account because their dividends are usually non-qualified, which is beneficial for a Roth IRA. Many of the REITs I own are also priced attractively at the moment, so this is a good year, I think, to up my REIT focus. Another 33% is going to be allocated towards growth stocks and ETFs that often pay little to no dividends. Now, given that I still have plenty of time before I'll be accessing these funds, I think it makes sense to allocate some of my contributions to higher growth, higher risk stocks that could maximize the capital gains and increase the overall value of my Roth. As I get closer to using the account, I'd likely pivot much of these towards more yield-focused, stable stocks. Then the remaining 33% of my purchases will go towards increasing core positions of dividend growth stocks and ETFs, such as Johnson & Johnson or SCHD, opportunistically. So on January 2nd, I made my first purchases in the Roth IRA for the year. First, I added 2 shares of Realty Income, ticker O, for $106.02. I think this is a great time to add O, the monthly dividend company, with a nearly 6% dividend yield right now. I'm liking that monthly cash flow coming into the account. It's priced attractively right now, and I'll leave a link in the description to a video I did a few weeks back where I dive deeper into Realty Income. I also added 5 shares of SCHG for $140.10. That's right, SCHG, not SCHD. This is the Schwab US Large Cap Growth ETF, which is similar to like the QQQ or Vanguard's VUG. This does pay a small dividend at 0.34%, but this one is really for the price appreciation I was talking about. SCHG shares are up about 327% over the last 10 years, while VOO and S&P 500 index fund has returned about 200% over that time. So if you have 10 years to hold on to something like this, it can really pay off. So SCHG is going to play a pretty big role in the Roth IRA strategy for 2025. That's where I plan to put the majority of my 33% of the purchasing money I'm allocating towards growth stocks. SCHG has a nice low expense ratio of 0.04%. These are the top 10 in SCHG. It's weird not to say SCHD because I talk about this stock so much. But Apple is at 11.57% of the fund. Microsoft is at 10.75% of the fund. Nvidia is at 9.67% of the fund. Amazon at 7.33%, Meta at 4.79%, Alphabet A at 3.73%, Tesla at 3.7%, Broadcom at 3.13%, Alphabet C at 3.07%, and Eli Lilly at 2.12%. And these top 10 stocks make up almost 60% of the total fund. So very concentrated on the Mag 7 there and the top stocks in the market. So just keep in mind, an investment like SCHD is going to be way more volatile than an S&P 500 index. It's a little different than the kinds of investments we normally talk about on the channel, as the focus is on dividend growth investing, but I'm just keeping my purchases transparent in this video. And then on January 8th, speaking of different, I also bought 1 share of iBit for $53.85. This is the iShares Bitcoin Trust ETF, and by BlackRock. It doesn't pay a dividend, and this ETF essentially tracks or attempts to track the performance of Bitcoin, allowing investors to get Bitcoin exposure in a place like my Charles Schwab Roth IRA, rather than having to purchase Bitcoin directly through exchanges. Now, I know this is a bit unconventional for a dividend-focused portfolio, but I like the idea of diversifying my Roth IRA holdings just a little bit, so I'm going to dollar cost average into this with like a share every month or so, just to add a little bit of diversification to the portfolio. I'm not going to get into much here more than that because it's a dividend investing channel, but just know it's a very tiny allocation to the overall Roth IRA. It's going to be less than 1%, but I just want a little exposure there. Then on January 22nd, I purchased 2 more shares of Realty Income for $109, continuing to build up that position. By the way, shout out to our viewer Greg Mitchell, who commented on a video asking how much O I have in the Roth. Well, Greg, at the moment I have 62 shares of Realty Income in the Roth, and I'm aiming to build this up to 100 shares in the year 2025. So thanks for the comment. Then with the craziness on January 27th, I got into buy mode and I increased a couple more of my positions. 1 share of Alphabet Inc., ticker GOOGL, for $196.84. Google dipped below $200, which is where I'm comfortable continuing to build my existing position in that one. I certainly don't see it as cheap, but I think it's probably the best value out of the Mag 7 right now. I'd love to see it drop some more, and they even started paying a dividend recently. It's not much, but they're paying 80 cents per share each quarter, and I could see this company becoming a dividend growth stock as it matures. I love Google, and I look for every opportunity I can add to it. I also added a share of Pepsi for the first time in quite a while. It set me back $154.23. Pepsi is a dividend king, and right now it's available at a yield higher than we've seen in a long time. The current yield of 3.51% is a massive jump from the 5-year average yield of 2.86%. So I'm pleased to have that opportunity to build this one up a little more. And let's hope we get more opportunities to invest in stocks like Pepsi and Google. I'd love to buy these two stocks all year long. That would be amazing. So altogether, that's $760 worth of purchases from the $600 I added into the Roth IRA. And that's simply consistently maxing out the Roth over the last couple years and not using DRIP. So that's a quick look at my Roth IRA activity in January. Alongside the Dividend Growth Income Portfolio, altogether it's about $1,400 invested between the two accounts with the dividends reinvested. So I'm excited to keep building both of these accounts, see how they evolve over 2025 and beyond. And I'm here to share that journey with you all. But please remember, this is just what's working for me right now. Everyone's situation is different, and I encourage you to do your own research or even consult with a financial advisor for personalized advice. Now, I want to hear from you. What stocks or ETFs did you add to your portfolio in the month of January? Drop a comment down below and let me know. And don't forget to subscribe, hit the notification bell so you don't miss my next video where I'm going to be breaking down the dividends I collected and the performance of the Dividend Growth Income Portfolio in the month of January. My public portfolio dedicated to building steady, growing income. You don't want to miss out, so stay tuned. And as always, keep investing.